Okay, so welcome everyone. My name is Mark, and I will be your tutor for this course. So what we will do today is we will discuss week 1. And here you can see the table of contents. There's only one thing I want to tell you before we start, and that is that I changed the order of the course a tiny bit. Not that much, just a little bit. What I did is I first discussed all the journal entries, and then I move on with all the other topics.
Zit al de weer cassette.
So for example, you have some journal entries in week 3. They should be here, but I already discussed it right here. So that's the only thing I changed. I moved the journal entries from week 3 already to this first part. So for the rest, the order is exactly the same as in the course. That's the only thing I changed. Okay. So what will we do today? I will tell you what accounting is, what the most important equations are in accounting, what journal entries are, how the whole bookkeeping cycle works. So how do you start with some transactions and eventually end up with an income statement and a balance sheet? So that's what we're going to do. And then we will discuss all kinds of complications you can encounter. Things like, what if you are a buyer? What if you are a supplier? You deliver the goods. What if you have discounts? What if you have transportation costs? What if you have returns and allowances? Those kind of complications. That will be basically the whole setup of today. We will, of course, not finish all the journal entries, but we will see how far we come. Just something I like to tell you. So I try to mix in as many exercises as I can. So I have included some old midterm questions. I've included some exam questions, some quiz questions from last year, so that you can also practice it a bit. But I have to tell you one thing. The first session, so today, is always a bit more theoretical. So I will be talking a bit more than normal, and you will see later in the course, you will have only me 15 minutes explaining something, and then you can make an exercise. And then I explain something for 15 minutes, and then you have again another exercise. That's how it will be working in the later sessions. But today it's a bit more theoretical than normally. Okay. So let's get started. So what is accounting? So I will, by the way, share this the summary afterwards. Else, if you really want to have it right now, I can do it in the break. Just let me know if you already want to have it in the break. So accounting is basically the process of getting a good overview of how your business is doing. And we have two subdomains. We have financial accounting, which will be the topic of week 1 to 3. And we have management accounting, which is the topic from week 4 to 6. So the first 3 weeks, financial accounting, last 3 weeks, management accounting. So what is financial accounting? Financial accounting is focused on the external stakeholders. So we want to inform the bank or the shareholders, external parties. And there are 3 statements important in particular. Those are the balance sheet, the income statement, and the cash flow statement. And today we will learn how to make a balance sheet and an income statement. That's one of the main topics of today. The cash flow statement, we will not do that one, but that is what you will learn in week 3. Okay. And then you have week 4 to 6. There you have the management accounting part. And that's made for internal use. So to inform the manager very well about the business. So you will see that this is less regulated. So everything goes. And in this course, in week 4 to 6, important things that we will work with are the ratios, some cost price calculations. You will see you have job costing or ABC costing, and some analytics about how is the manager doing Has he more sales or less sales than we thought he would have? Is he working efficient with the materials, with the labor? Do we pay too much for labor hours? Things like that. That's for example what you will do in week 6. So that's how the course is set up. We will now start with financial accounting. And the first thing that's really important with financial accounting is the balance sheet. So the balance sheet gives an overview of the assets, liabilities, and equity at a specific point in time. So we know what do we have, what do we own, and what do we owe. And it's pretty important that you know it's based on a specific moment in time. What do we mean with that? Okay, so if you have a number in this course, the first thing you want to ask yourself is, does it relate or to a particular period? So the level of debt that we have, that relates to a particular moment. Today I have this amount of debt. But your profit, that relates, for example, to a particular period. I made a profit in the year 2018 or in the month January. So that's the first distinction. Does it relate to a particular moment or to a particular period? And the balance sheet relates to a particular moment. So I know how much assets do I have at a particular moment. So the 1st of January here, how much equity do I have and how much liabilities do I have? And of course, the balance sheet always balances. So the assets will equal the liabilities plus the equity. That's what you always have. You can, of course, solve it for equity and then you get this equation. So it's a really easy equation. Assets is liability plus equity, but it's a really fundamental equation as well. So it's really important. Okay, so that's the balance sheet. So what are examples of assets? Well, cash. So that's just how much you have in terms of cash so that you can have that you always have to make sure that you have enough to meet your short-term obligations. And then you have accounts receivable. So if you sold something to a supplier, to a customer, typically the customer will not pay you directly, but he will pay you in a few days afterwards. And then, so after you deliver the goods and your customer didn't pay you, he's in accounts receivable. So you will still receive some money from goods that you already supplied. That's an accounts receivable. Inventory is important, buildings, machines, but you also have non-material assets. So, for example, IT systems, patents, but those will not be a big part of this course. I don't think you will get that, but I just want to make sure that not all the assets are material. You can also have immaterial assets. Okay. Liabilities. So we said with assets, we said everything that the organization owns, right? That's what we said with assets. But with liabilities, we say what the organization owes. So for example, bank loans, bonds, the accounts payable is an important one. That's that you bought something from a supplier, but you didn't pay for it yet. So then you have an accounts payable, a liability. You still need to pay your supplier for goods that you already received. That's an accounts payable and also an important one. But also unpaid things like unpaid salaries, unpaid taxes, unpaid dividends, etc. Things that you didn't pay for yet. Okay, so those are the liabilities. And then here you see the equity. And the equity is basically a residual account. So we already said assets equals liabilities plus equity. Then equity equals the assets minus the liabilities, right? So you can write down the following equation. The following thing will be pretty important to write down. The change in equity will be the change in assets, minus the change in liabilities. So if your assets go up by 150, for example, and your liabilities increase by only 100, you will see that your equity will go up by 50, for example. So write down this equation: the delta of equity equals the delta of assets minus the delta of liability. Okay. So that's one way in which your equity can change, but there's also another formula for it. Your equity can also change. So basically, if you make a net profit, your equity will go up. Saying that everything else remains the same. So if you make a profit, in principle, your equity will go up. So if the business is doing well, if the operations are going well, in principle, the equity will go up, keeping everything else equal. But also the transactions with owners will affect it. Am I lacking, by the way? Can you still hear me well?
Yes.
Okay. Also, I can just switch rooms. But... Okay. And the second reason why equity can change is because of transactions with owners. So the dividend, what you can remember, if you pay it, cash goes down on the left side and equity will go down on the right side. So you can write down, if dividend is paid, equity goes down. You can write it down. If dividend is paid, equity goes down. Then you have the issuing of shares. When a company issues shares, it basically creates shares out of the blue, and then it sells it in the market. What happens if you issue shares is cash goes up on the left side and equity goes up on the right side. So with the issuing of shares, you will see that equity will go up. So you can write it down. When you issue shares, equity goes up. Do you guys know what the opposite is of issuing shares? Does anyone know that? What is the opposite of issuing shares? Any ideas? So the opposite of issuing shares. Anyone knows?
Retaining the earnings, but I'm not sure.
That would be the opposite of dividend. So retaining the earnings is indeed the opposite of paying a dividend. So your profit minus what you pay out as dividend, that's the retained earnings. Very good. But what is the opposite of issuing shares?
Issued shares.
What did you say, Alexandra?
Unissued shares.
Unissued shares? Yeah. Repurchasing shares. So instead of creating new shares and selling it into market, you could also take your own cash and buy back some of the shares that are already outstanding. So the opposite, efficient shares, share buybacks. That's the opposite. If you repurchase shares, cash will obviously go down on the asset side and equity will go down on the right side. So by repurchasing shares, the equity will go down. That's what you will see. Okay. And now we can formally put that into an equation. And that's this one. You can write it down. The change in equity is the change in common stock. And how can common stock change? Well, if you issue shares, common stock will go up. If you repurchase shares, the common stock will go down. Plus this part, that this part is your profit. Minus dividends. So here you can see it, right? So if we issue shares, this thing will be positive and then equity will go up. If you repurchase shares, this thing will be negative and then equity will go down. If you make a profit, equity goes up. And if you pay a dividend, equity will go down. Here you can see it formally in a formula. Okay, so please write down that second equation. And if you wrote it down, then I can say that I didn't include taxes. And the reason for that is because this is one of the early formulas in the book. And there they don't do anything with taxes yet. Also, if I look at old exam questions, they didn't use taxes yet at this point. But if you are interested in how it would look like, I can now change the formula a bit. So I think you now wrote it down. So where you now see this point here you can also have minus taxes in between. So then your profit is revenues minus expenses minus taxes. That's then the formula for profit. So basically this part here, that will be your formula for profit. So revenues minus expenses minus taxes, that's the net profit that you have. And then minus dividend, that's the change in retained earnings. So that's if you would have taxes. I never saw that, but if you're wondering, that's how it would look. Okay. So what I will do, I will show you how to do one of those typical exam questions. So this is a really typical one. And then after we did this one together, I have another exam question that you could do on your own. And this midterm question we will do together. And with the exam question after this one, you have some time to do it on your own. And then you can submit your answer via the Zoom chat to me in person. Okay, so here we go. We start. Oh, I see something in chat. No, nothing important. So we start by writing down the formulas that we have. So the first formula for the change in equity was the change in assets minus the change in liabilities, right? And then the second formula for the change in equity was the change in common stock. So I will call it change in common stock plus, does anyone know?
Revenues,
Yes, revenues minus,
expenses and dividend.
yes. So those are the two formulas you need to learn by heart. And then this part, of course, is your profit, right? And this part is your change in retained earnings. Okay. Okay, so if you wrote this down, then we will go to the question. And I will also make a, maybe it's nice if I make a picture for you guys in the WhatsApp if you want that. Oh, sorry. So let me make a picture for you as well, if you want to. Okay, so I now put a picture in the WhatsApp group. So the assets at the starting point were 600, but at the end they were 650. So my question to you is, what is the change in the assets? Is it a positive 50 or negative 50? It's a positive 50, right? So here I can insert 50. Okay. How about the change in liabilities? So with the liabilities, we first had 200. And at the end, they were 300. So what is the change in liabilities? Positive 100, right? So my question is, what is the change in equity then? What is the change in equity? Minus 50, very good. So the equity went down by 50. So now I can also insert it in the other equation, minus 50. And then we will try to fill in the rest of the formula. So let's have a look. Shares were issued for 50 euro. Which variable are they talking about? Shares were issued for 50 euro. If I look at this formula, shares are issued for 50 euro. Which of the variables are they talking about? Any ideas?
Dividends.
No, not the dividend. So shares are issued worth of 50 euro. The common stock, very good. So this common stock went up because they issued 50 euro of shares. If you repurchase it, they have a negative change in common stock. Okay. Then we go back. They say dividends were paid, revenues were 370 euro and dividends were paid for a total of 20. So revenues 370, dividends are 20. So here we can fill in 370. And here we can fill in 20. And then this is the unknown variable. Let's call it X. Could you guys solve it for the expenses now? Because we know we have a whole equation with only one unknown variable. So that means we can solve it, right? What is the X? Would somebody give me the value for that? Yeah, two different answers so far. So I'm still waiting because I have now. Yes, I get the maturity says it's 450. Right. So let's check if it's indeed 450. Yes, it's 450. Is this all clear for everyone? Okay. Then here is an action question. Feel free to do it on your own. You can just submit your answer via the Zoom, but do it with a private message so that other people cannot see your answer. And then if I see that the majority has submitted its answer, I will move on to the next topic. So good luck. If you don't know how the formula was looking like, just feel free to ask. Oh, sorry. I now see your question, Jelte. Would you show the formula? Yes, I will also make a picture of it and put it in the WhatsApp. So it's now in the WhatsApp group as well. So I think Hang and Isa have it correctly. I think you, Konrad, didn't have it correctly. Maybe you want to check your calculations. Maybe something with the plus or minus went wrong. I don't know. So Alexandros, I think you made a small mistake. Lorenzo, you have it correctly. So I only got 4 answers so far. So I'm just waiting because there are 27 people in this class. I have to wait a bit longer then. So I get a question from Lorenzo if we get the formulas in the exam. No. So you need to learn everything by heart. Yeah. Sietse, you have it correct. Hendrik, you also have it correct. So I think I would just so SC Lam has it correct. Dennis has it correct. Yuki, you made a small mistake. So I think it's time to discuss it, right? So I think it was not that difficult. The only thing you maybe need to know is what they mean with net capital investments. So the net capital investments are basically the change in the common stock. And I will tell you what they mean with net capital investments. It means what they issue in shares minus what they repurchase in shares. That's what you net have invested. So what you issue minus what you repurchase. Those are the net capital investments, and those are 90. Okay. So the idea was that if you had those formulas, you could fill everything in. So you could calculate that the change in equity is 320. Then you can substitute that into here. Then you can fill in those numbers because they were literally given in the question. And then only the revenues was your own unknown variable. So then you could solve it for revenues, and then you should end up with 1530. Okay, so it's just filling in the formulas and then solving it for revenues. That's what you have to do here. Is that clear for everyone? Yes? So Yuki, what went wrong? Do you now know?
Yeah, I
What
thought
went
that in the question, they stated that there was equity recorded of 1260, but maybe I read it wrong.
Let's see.
Oh.
Expense. And
Yeah.
you thought it was equity.
Yeah, that was my what I had wrong, but I understand it, so thank you.
All right. So let's move on to the next question then. To the next topic. So for the bookkeeping, it might be important to know what the legal structure is of your company. So we have three different structures: proprietorships, partnerships, and corporations. What's a proprietorship? A proprietorship is in Dutch eenmanszaak. So a proprietorship is a eenmanszaak in Dutch. So there's no clear distinction between private money and company money. The proprietors have unlimited liability for all debts that the company has, and the profit is just private income. So the idea here is that you also are not working with shares or with dividends or whatever. That's a proprietorship. A partnership is basically the same, but then with two or more people. And in Dutch, it's vennootschap onder firm. We will not use those two during this course. We will work with corporations. In Dutch, een BV of an NV. So with a corporation, there is a formal separation between ownership and decision making. And very important, the corporation itself is a legal entity. So, and then the ownership can be transferred via shares. So with corporations, which we will use in this course, there you do have shares. And the stockholders, the owners, they have limited liability. Okay. And then the corporation can be private or public. You can have publicly traded shares or just only privately traded shares. So that's what we will use in this course. Why I'm saying this is because of the following reason. If you look at the book, sometimes you will see that the journal entries you're seeing there are for proprietorships or partnerships. And that's not what you have to do on the exam. On the exam, you will work with corporations. So make sure to only use journal entries from the book that are based on corporations, where you do have dividends, you do have stocks, etc. Okay. So we now discussed the balance sheet. Then the next important financial statement is the income statement. So the income statement tells us what the change is, what the revenue is in a particular period. So again, we said a number can relate to a particular moment or to a particular period, and the revenue is based on a particular period. And then the expenses are shown, and then eventually the net income. So revenues minus expenses will be equal to your net income. And here again, we assume there are no taxes, but of course, also taxes should be deducted before you have your net income. So that's one thing we will also try to make today. Here's a midterm question. They are writing down some statements, and I would like you to answer this via the Zoom chat. So are the statements true? And before you try to answer it, think back about what the formula is for the net profit. Net profit is the same as net income. So net profit is net income, right? It's just the same. And what is the formula for that? Revenues minus expenses minus dividend. Sorry, not minus dividend, minus taxes, sorry. So submit via Zoom if you think statements are true. So your answer could, for example, be statement 1 is true, statement 2 is false. That might be your answer, for example. So Hendrik, you have it correct. So only Hendrik has it correct. Also Hong has it correct. Everyone else who submitted an answer has it incorrect. Alexandros has it correct. So only Hendrik, Hong, and Alexandros have it correct. Natalia also has it correct. Everyone else made a mistake. So I think I can already discuss it. The answer is both statements are true. Both statements are true. Because the dividends are not part of the formula. Only revenues, expense, and taxes impact the net income. So the dividends do not affect the net profit. So the first statement is true. How about the second statement? The transactions with stockholders never affect net income. Okay, first of all, which transactions do we have with stockholders? Could you name them? I think we discussed 3 of them. What are the 3 transactions with stockholders? Could somebody name one?
Common stock.
Yeah, but could you decompose the change in common stock? Because there are 2 transactions that affect the change in common stock.
Issuing shares.
Yes. And what's the opposite?
Purchasing shares.
Yes. And then the last one.
Dividends.
Dividends. Those are the transactions with stockholders. You can sell shares to them, you can buy shares from them, and you can pay them a dividend. Okay. All 3 are not part of this equation, right? So therefore they don't impact the net income. Do they affect the equity? Yes, definitely. The 3 transactions with stockholders, they do affect the value of equity, but they don't affect the net income. Is that clear for everyone? Yes. So statement 1 and 2 are correct. Then a distinction between main and assistant accounts. So we eventually what our main learning goal was today is how do you make a balance sheet and an income statement, right? And to do that, you have to know the difference between a main and an assistant account. It's a helpful distinction. So because for the bookkeeping process, you need to know some theory before I will show you the examples. So there's a bit of theory from this point, and then I will show you some examples. So one important theoretical thing is the difference between a main and an assistant account. So all the main accounts are the accounts that you will transfer to the next fiscal year. What do they mean with that? Main accounts are just things that you put on your balance sheet. And assistant accounts are the things that you put on your income statement. So main accounts will go to the balance sheet, and assistant accounts will go to the income statement. All right. So what are examples for main accounts? Cash, accounts receivables, accounts payables, things that are on the balance sheet. Then what are the assistant accounts? Well, the revenues, the expenses, the dividends, those are assistant accounts. Okay. So wage expenses, rent expenses, those are assistant accounts. When you're going to do your bookkeeping, you always have to keep those three principles into account. Why is that? So why is that? Because if you know those three principles, you sort of can reason a bit what are the correct journal entries you will make. So this is just some theory. I will just tell it a bit what it means now. You don't have to remember this already, but then when in the future I will refer, you do a particular example of a journal entry, then I will refer back to those principles. So it's nice that you have already heard them once, but I will definitely also come back to them later because I don't expect you to now already completely understand them, but it's nice that you have already heard about them once. Okay, so one of the accounting principles is the realization principle. So the idea is with accounting, we want to be as conservative as possible, right? So if we we expect to get a particular revenue, we don't record it yet. We will only record the revenue when it's realized. So I will give you an example. If you now get a contract to do the cleaning of a particular factory for the upcoming year, you already are getting paid upfront. So you already received the money, and then in the upcoming year, you need to do the cleaning of that factory. Then at that moment that you receive the money, you cannot record that revenue yet. You can only record that revenue when it's realized. So after you perform the cleaning services, then you're allowed to record that revenue, that profit. So that's the realization principle. You wait with recording your revenue until it's realized. In this example, until you actually performed the service, you really cleaned the factory. Then you can record it. Okay, that's the realization principle. Then the matching principle. With the matching principle, they're saying costs and revenues should be recorded in the same period. So your expenses and your revenues should be recorded in the same period. So, for example, let's say in 2017, I buy some goods. So money goes out of the pocket. And then in 2018, I sell some goods. Then money comes in, right? What you don't, let's say that this is minus 100 and this is a positive 150. What you don't want is that your profit will be negative 100 here and then a positive 150 there. That's not applying the matching principle. So this would be wrong. What you want to do is that you don't have any profits or losses in 2017. And then you match the revenues with the expenses in 2018. So that you here only have a profit of 50 euro. Do you see that? That's applying the matching principle. So if you have some cash outflow in 2017, a cash inflow in 2018, you want to match those expense and revenues so that you only have this positive 50 in 2018 and no profit or loss in 2017. That's the matching principle. So you will see that in the future, if we are buying some stuff, we will not record any expenses, even though cash goes out of the pocket. When we are selling, then you will see that we will record the revenues and the expenses. So when you sell, you record the expenses. That's one of the things you will see. That's because of the matching principle, but I will refer back to it when we are discussing that complication. Okay. Then the prudence principle, the last important principle. There are three more, but this is the last important one. The prudence principle is basically opposite of the realization principle. So with the realization principle, we want to record revenues when they're realized. But with the prudence principle, it's the opposite. Losses are recorded when they're foreseeable. So again, with accounting, we want to be as conservative as possible. So with revenues, we wait until it's realized. But with losses, we don't do that. We take the losses as soon as we can see that they're coming. Okay, why is that important? If you, for example, sell something, you already know that a fraction of your customers will not pay you, right? So you could wait until you're 100% certain that they will not pay you. But if you apply this prudence principle, then if you are selling something to a customer, you will already take into account that you have to write off a part of your account receivables because you already know that they will not pay you. That's because of the prudence principle. So if you sell something, you already know that you have to write off a few of your account receivables, and that's applying the prudence principle. So you already record the losses when it's foreseeable. I hope that one is clear. So the prudence principle, record losses when they're foreseeable, not when it's realized. Do it as early as possible with the losses. Okay. Then the going concern principle, those three are less important. The going concern principle is that you assume that the company will not go bankrupt in the foreseeable future. Why are you doing that? Because of that, you can register assets at the market value instead of the way lower liquidation value. So if a company goes bankrupt, you have to sell your assets really fast, and that means that you will probably get less for it. So the going concern principle is important for the valuation of your assets on your balance sheet, but it's not that important in this course. You just need to learn it by heart. The monetary entity principle. So all the transactions must be measured in a monetary entity. So for example, euros, and you has to be consistent with using your monetary entity. So if you choose to use euros, you have to always use euros in your reporting. Then the entity principle, that states that the activities of the companies should be separated from the activities of the owners. So the company has to have its own bookkeeping, and you don't want to mix up the assets and liabilities of the company with the assets and liabilities of the private owner. So you need that separated. Okay. So again, the main learning objective is that you know how a bookkeeping works, and then those principles, you need to know them when we're doing the bookkeeping. There's some more theory, but eventually we will show you some examples. Okay. So here you can see what bookkeeping is. Bookkeeping is just the process of registering transactions, and it's only one of the aspects of accounting. So accounting involves way more than only bookkeeping, also controlling. But this course is mainly based on bookkeeping. I don't think I need to go too much in detail about this. So with the journal entries, so I can maybe already tell you a bit what a journal entry is. if you get a transaction, so a transaction might be that you pay your suppliers or you buy some inventory, something like that. That could be a transaction. Then you have to register that using a journal entry. And that journal entry, if you, for example, if you pay your suppliers, you will see that accounts payables will go down by 100 euro, for example, if you pay your supplier. And then your cash will go down by 100 euro. And that this is how your journal entry will look like, for example. Okay. When you are going to make those journal entries, there are a few things you want to keep into account. First of all, you have to use the appendix if you get one on your exam. So on your exam, you will probably get something like this. Then you always need to use the names from the exam, from the appendix. So with cash, you have to use cash because on the exam, they call it cash, like you're seeing here, right? Then you should not use, for example, liquid assets. Okay. If you have a multiple choice, don't worry about this. If it's multiple choice, you can just choose the multiple choice answer. Then you don't get an appendix. Okay, that's the first thing. Another thing is always give calculations below the journal entry. So if you have some journal entry, write down below your calculations. I will later show you what I mean with that. Make sure you count the years, months, and percentages precisely. So this might sound a bit stupid, but don't laugh about it. But it's really important that you know the order of all the months. So January, February, March, April, etc. Because you can get a story where you have to count the number of months that have exceeded since the moment that you bought something, for example. So you always want to be able to calculate how much months have passed since the moment something happens. So make sure if you don't know the order of the months and which months you have, make sure to know them. I always notice there are a few students that don't know that. Don't be ashamed about it. You don't have to tell me, but make sure you know that. And always be clear which account is debited or credited. So the left side is debit, the right side is credit. Make sure to use different columns for that. Sometimes students mix it up. This I will discuss later with you guys. For now, I think it's the best if we just do some concrete examples. Okay. So at this point, what I now will do, I will use the next 20 or 15 minutes to illustrate how the bookkeeping cycle works. So the end will be that we have an income statement and a balance sheet. And then after that, you will do a particular midterm question. Okay. So let's get started. Step one of the bookkeeping cycle is that you will analyze the transaction. So you will have a transaction where they say, we purchase a delivery car costing 32,000 euro. We pay 4,000 in cash now, and we pay the remaining 28,000 within 2 months. So we pay it later, which means it will become an accounts payable. Okay. So how it works is you can remember that if you have assets, if you want to increase assets, you will debit it. And if you want to decrease assets, you do the opposite, so then you credit it. But with liabilities, it works the opposite. So liabilities are on the right side of your balance sheet. So if you want to increase liabilities, then you have to credit it. And if you want to decrease a liability, you have to debit it. This is, you can learn it by heart, but you can also reason that if you want to have something by default on your left side, you need to debit it to increase it. If you have something by default on your right side, you need to credit it to increase it. So if you wrote it down, and we'll go back to the example. Okay, so I think everybody wrote it down. Let me know if you need more time. Okay. So in this story, we purchased a car, an automobile, which is an asset. So I need to debit the asset, the automobile, to increase it. Does it make sense? That's what I'm doing here. I pay with cash. So cash goes down. Should we use automobiles or delivery car? Very good question. So if you're wondering about that, you just go to the appendix on your exam. And then you will see that you have automobiles right here. So then you know I have to use automobiles and not delivery car. Yeah. But if you get multiple choice, which you have with the quizzes, then you don't have to worry about it. Yeah. Okay. So, okay. So the cash goes down, right? And then you need to credit it. That's what we said. Okay, the accounts payable, that's this part, that's the part we don't pay yet, that will be an accounts payable. That's a liability, and to increase the liability, we need to credit that one, right? Okay, that's how you make a journal entry. And then this should always balance. The left side should always be equal to the right side. Okay, that's the starting point of a journal entry. Okay. So the first step was analyze, second step was journalize, the third step is posting. So the idea is for each account that you have, you keep track on its history. So for each account, for example, the account cash, you want to know, okay, what happened with cash? What are all the changes in that account? So that's the accounts in the ledger. Okay. So what you will see here is we lowered the cash by 4,000, right? Then we will post that at this point. So we now posted that 4,000 in the account. So this T balance keeps track on all the history. So we can now see we started with 6,000 in cash, then we took 500 out, and now we just took 4,000 out. So we now have 1,500 of cash left at the end. Do you guys see what a T account is? It's just some account to keep track on all the changes in that thing. And you have this account not only for cash, but you would also have this account for automobiles, for your accounts payables, for each account that you can think of. I just now took the cash as an example. Okay. So this was just a small introduction. Now we will do a more extensive example of the whole bookkeeping cycle. And then after this example, we will have a small break, and then I have some midterm questions for you guys. So how does the bookkeeping cycle look like? So you start by analyzing it, you get a particular transaction, you journalize it, then you post it. But then afterwards, there are some more steps. You make a trial balance, which I will show you, adjusting entry, adjust the trial balance. And then at the end, you have your financial statements, which are the balance sheet and the income statement. And that's the part we will discuss now, which is a pretty important part. Okay, so let's start with the more extensive example. So analyze the following transactions. The owner invested 2,000 euro in return for shares. Okay. So let's start with A. What happens with cash? So a stockholder puts 2,000 euro into the business to get some shares. What happens with the cash? Will it go up or down? it will go up, right? So we are going to debit the cash, right? So write down 2,000 euro here. So this will be a debit, right? So DC. Okay. Then the shares, which is common stock, needs to go up, right? I need to have some more space. 1 second. There we go. The common stock is on the right side. So to increase that, I need to debit it, to credit it, sorry. This is what happens. So I hope it's not mirrored because of Zoom, but maybe I can check myself, by the way. So the left side, no, that's, yeah, for me, that's the left side, but for you, it's the right side, right? I don't know if it's mirrored. I think I have to do it like this. Okay. So for you, the cash goes up, which is the left side for you, right? And then the common stock, which is the right side for you, that will also go up by 2,000. So cash goes up, common stock goes up. That's how it happens here. Okay. Yeah, so we debit cash indeed because cash is on the left side of the equation. So here you could also see it, right? Asset is cash and it goes up, so we have to debit the cash. Okay, that's what you're seeing here. Okay. So let's do another one. B. The company borrowed 6,000 from a bank. So should I debit or credit the cash? You can feel free to turn on your microphone as well, of course. So yes, we need to debit the cash, right? So cash 6,000 debit, right? Okay. Then the name is not that important. You can just find it into the appendix, but it's a notes payable. So that's when you borrow something from the bank. And that's also 6,000. So I'm increasing my asset of 6,000 and I'm increasing my liability of 6,000. Yes, very good, Dennis. Yeah, that's a good question, Kim. They're not that consistent with that. I didn't see a pattern in that yet, actually. So yeah, that's a good question. If you know the answer, I'm also happy to hear it. They're a bit fake about that. Okay. So that's B. So then C. Equipment that cost 3,000 was paid in cash. What do you guys think that I should do here? So with D, what do you think I need to write down here? Oh, sorry, C. I should do C. So I purchased 10,000 of equipment. What do you guys think I should do? Yes, I need to debit the equipment worth 10,000. So equipment goes up by 10,000. And cash will go down. And indeed, if cash goes down, we debit it, we credit it with 8,000 here. And then the note payable. 2,000 here. Very good. So this is a liability that goes up. So then you credit the liability. Very good. Notice, by the way, that if you credit something, you leave some space here. So it's, of course, in another column, but also with the names, you leave some space here when you credit something. Okay, so that's journal entry C. Okay. Maybe it's nice to keep this one here for a second. We will now do transaction D. Here we are going to return it. And that means that we have to do the opposite. So if we buy equipment of 10,000, we debit it. But if we return it, I already know that I should credit the equipment. Right? This is D. So I already know that I should credit the equipment for 3,000 here. That's what you're seeing. Okay. My question is, what should I debit then? So what should be debited? Yes, the accounts receivable. Very good. So accounts receivable. I need some more space. 3,000. Very good. That's the. So always remember with the return, you just do the opposite. So if you debited equipment to increase it, you will credit the equipment to decrease it. Okay. So that's D. Then I will erase that. Then E. The company provided services for 8,000 and received cash. Okay, so this one I didn't discuss yet. So let me write it down on the whiteboard. Do you guys remember this overview? I will now add some more important situations to it. Because you remember that you also had the income statement, right? And the income statement affects the balance sheet indirectly by changing the equity. So if you have a revenue, the revenue was an assistant account to increase the equity, right? So the revenue should increase the equity. Equity is on the right side. So the revenue will be credited to increase the right side, to increase the equity. And then this is just the opposite, right? You can forget about that. With expenses, you want to lower the equity, which is on the right side. And to lower something that's on the right side, you need to debit it. So expenses are debited so that they lower the equity, the thing that was on the right side. And this is just the opposite, right? See something in the chat? Can you repeat that about the expenses? Yes, of course. So expenses need to lower the equity. And to lower something that's on the right side, we need to debit it. So that's how you know it's debit. Expenses need to lower equity. Equity is on the right side, so we need to debit it. Okay. Dividends basically work like an expense. You also want to lower your equity, so you need to debit it to do that. And it looks maybe a bit much to remember, but you can remember that this is the only column you need to remember. This is the default situation. So the typical situation is that you receive some asset, then you debit it. The typical situation is that you make a revenue, so you will credit. This is the column you should actually remember. The other one is just the opposite and is less used. So if you pay a dividend, you will debit the dividend. So remember this red column, that's the default situation. Okay, so take your time to write it down. We will finish this. There's examples and then we have a small break. What do we mean with that, George? I don't know what you mean with drawings. But you're basically withdrawing a bit of your profit. I don't know if that's what you mean. So I got a question from Alex. Is there also a crash course for this? So now we scheduled a weekly course, which is starting next Monday. No, yeah, next Monday. But there will also be a crash course for this. I'm not sure if that's also relevant for your quizzes and the midterm. So with the weekly course, you will also be prepared for your quizzes, of course, and the midterm, if I'm correct. But with the crash course, I think that will be only for the final. So if you can choose, I would recommend to go to the weekly course. But I think there's also a crash course, and I'm doing the weekly courses indeed. That's next Monday. Yeah. Okay. So where were we? We discussed D, right? So we will now do E and F, and then we take a break. So E. Company provided services for 8,000 and received cash. Okay, so here we have a revenue, right? And with a revenue, do we debit it or do we credit it? No, the weekly course will not be online. However, the fiscal group at the FU is almost full. And then I will open a second weekly group, and that one will be online. So probably there will come an online course as well. Yes. It depends a bit if the weekly group will be full, which is fiscal. Then we will open a second group, which will be online. And I think it's almost full, so there will probably be an online course. Yes. Yes, and I also have recordings. So if you go to the course, you will also get the recordings. Yes. So the revenues. Do I need to debit it or credit it? Need to debit it, right? We saw that in the overview. So 8,000. Then I pay with it in cash. What did we say? To lower cash, I need to credit it, right? Do you guys remember that? So that's what we said here. Okay. So this is E, right? Oh. Excuse me. I messed it up. I was a bit distracted. So of course, I receive cash, so I should debit the cash. I'm really sorry. And it should be the opposite. If we increase the revenues, it increases equity, so I need to credit the equity. It's in the overview. I'm really sorry. So here I will show you. So we said with revenues, we need to credit it, right? And here you can see it. Oh. So this is how it will look like. I'm really sorry. Okay. So would it matter if we wrote down only revenue? Well, I think it matters. So you will see that. I will also show that later today, that you have service revenue and sales revenue. And for a service company, you write down service revenue. And for a merchandising firm, which I will discuss later what it is, then you will write down sales revenue. So you can see it also in the appendix, but with multiple choice, you don't have to worry about it. Just they will not try to trick you with that or something. Okay, so why do I not write down sales revenue? So sales revenue is with a merchandising firm. That's when you buy a good for low price and sell it for a higher price. So with services, you write down service revenue. And when you're selling goods, you write down sales revenue. Service revenue. With goods, you use sales revenue. Okay. So here you write down surface. Oh. Surface. Revenues. Okay. So that's E. Then F, the last one, and then we have a break. Wages of 2,000 were paid in cash. So that's an expense, right? We have some wage expense. Do we debit or credit expenses? What did we say in the overview? Did we debit or credit expenses?
Debit, right?
Yes, we want to lower the equity and then we need to debit the equity. So 2,000. And cash goes down, right? Because we pay for the, and then we need to credit the cash. So to lower an asset, we need to credit it. Okay. So those are just the basics. So I will tell you how we will proceed, just so that you know what you can expect after the break. So I will now raise this. So after the break, I will show you how to set up with all those steps the final statements, so the balance sheet and the income statement. So this is what we're working to, how to get this one. Then afterwards, I have some midterm question for you. And then I will discuss all sorts of complications that you can encounter. So one of them are the differences in inventory systems. How does it work when you buy something, when you sell something? What if you have transport costs, returns, discounts, etc.? So we'll go through all those different situations. There are way more complications, which I will all discuss. In between we will also practice some quiz exercises. You can have more complications like allowances, etc., etc. And then at the end, have some exam questions that you can all do. We will not do those exam questions today, but that's what we will do next Monday. Then we will finish those exam questions that you're seeing here. But this is how the course is set up. So I show you first how you can make a balance sheet income statement. Then I show you some complications. And then afterwards, you will do some exam questions. So that's how this is scheduled. Okay, so let's have a break. I will go back to the slides where we left. Okay. Shall we do a break of 10 minutes? So at 33, we continue. Okay. See you then, guys. we will continue in a minute. I just sent you the summary, by the way. So sorry that I didn't do it before the class started. So. Okay, are you guys ready to continue? Let's continue then. Okay. So this is the appendix. There's another complication that you can have. So you will see that you will sort of get the idea of how you make a journal entry. But the difficulties are all the different complications that you can encounter. And what I aim to do is to go all the possible complications you can have so that you recognize them on the exam. And one of those complications that you can have is a deferral. So what you have with a deferral is you already receive or pay cash now, but you're not allowed to already register expenses or revenues. You will do that later. So a deferral is you already receive or pay cash now, but you will not already register the revenues or expenses. That's a deferred revenue or expense. Okay, so let me show you two examples. With the deferred revenue, you already received the cash now, but you're not allowed to already record the revenue. With the deferred expense, you already pay the cash now, but you're not allowed to write down the expenses yet. Okay, so let's do G. So with G, you receive 1,200 euro in advance for a 1-year service contract. So you already received the money. So cash goes up by 1,200, but you're not allowed to already record the revenues. Do you know because of which principle that is with G? Does anyone know? Sorry? So I know that I will get the revenue in the future. It's foreseeable, but still I cannot already register the revenue because it's not realized yet. I didn't perform the service yet. Do you guys know which principle that is? Because we had 3 principles, right? Prudence, matching, but what's the third? What's the principle here that we have to take into consideration? Do you guys know that?
Realization.
Yes, the realization principle. So because of the realization principle, I cannot write down service revenue. No, I'm not writing down service revenue here. I'm writing down unearned revenue. And this unearned revenue is not a revenue. It's a liability. So this here is a liability. So this is a very important complication that you can get on the exam. The unearned revenue. This is a liability. So assets go up by 1,200 and liabilities will go up by 1,200. Okay. Then example H. The company purchases and pays for a 1-year insurance for 2,400. So you already pay upfront for an insurance of 2,400. Then of course, cash will go down by 2,400. No discussion about that, right? 2,400 goes out of the pocket. Can I already write down an expense here? No, you will write down prepaid insurance premiums. So that will be 2,400 here. So this is an asset. So if you have a prepaid insurance premium, the asset prepaid insurance premiums goes up by 2,400. This here is an asset and not an expense. So that's the whole thing with the deferral. So again, with the deferral, today you register something with cash, but you don't register expenses or revenues yet. Okay. That's the deferral. And they are interesting because you will see that cash and expenses slash revenues are two different things, right? You can have a cash outflow, but that's something different than an expense. You can have a cash inflow, but that's something different than a revenue. It's not necessarily the same. Okay, that's what I tried to show you here. Okay. So the third step was to post everything. This is quite time consuming. So you for example, remember that here we had 1,200 of cash and 1,200 of unearned revenue, right? Then you will post that into the ledger. So here I did it for only one journal entry, but then you can do that for every single journal entry we created, right? So I will show you another one. Here we set 2,400 for prepaid insurance premiums, 2,400 for cash. And then I can post those numbers. So here I post it, and here I post it. And you can do that for each journal entry. That's the third step of the accounting cycle. Okay. So now you know where all the numbers come from. Then what you do is you look, okay, which side is bigger, the debit side or the credit side? So if I add all those numbers, and then I compare the difference between the sum of all those numbers, I will see that the left side is bigger than the right side, right? So it's 4,800 bigger. So then I know cash will be 4,800. With equipment, I see that the left side is 7,000 euro bigger than the right side. So then I know that equipment will be 7,000 debit. Do you guys get how I got all those total amounts? So you now know how I get all those numbers here, right? Those are clear, right? Okay. Then we go to the fourth step. So the first step was analyze, second step was journalize, third step was post. The fourth step of the accounting cycle will be the trial balance. So we take all the total amounts. So for example, this cash here and this equipment, 4,800, 7,000. And I put it into this trial balance. You see that? If you have some credit amounts, that's also fine. So for example, this 1,200 and this 8,000, for example, I can also put it down here, 1,200 and 8,000. So I put all those numbers in this balance, which is called a trial balance. And what you should have is that those two are exactly equal to each other. That's what we want to have here. If those two are equal to each other, it's good. If they're not equal to each other, you made a mistake somewhere. So that's why we're checking this. That's the trial balance. Debit should equal credit, else we have made a mistake. Okay. Then the fifth step is really important for the exam as well. Those are adjusting entries. So the idea is that there are some reasons why cash flows are different from expenses slash revenues, right? And we call those deferrals and accruals. The deferrals we already discussed, right? Could somebody explain to me what the deferral was again? What was the deferral again? Is there someone that can explain it to me? The deferral was you already pay or receive cash now, but you will have the expense and revenue later, right? You don't have an expense or revenue yet. Do you remember that from a deferral? An accrual is the opposite. With deferrals, you have cash now, expense revenue later. But with an accrual, it's the opposite. With an accrual, you now already have the revenue or the expense, but you will not do anything with cash. You will do the cash later with an accrual. So deferral, cash now. And then the revenue or expense will come later. With an accrual, revenue or the expense now. And then the cash will come later. That's what an accrual will do. And I will show you some examples of that. So here, I'm going to show you an accrued revenue. With an accrued revenue, you will have the revenue now, but nothing with cash. So let me show you an example. In your administration, you see that you have performed services equal to 500, which have not been billed yet. So you did make the revenue, you already performed the services, but you don't have any cash received yet. That's an accrued revenue. You already should have this revenue because you performed the service, you earned it, but you simply didn't receive the cash yet. So what you will do is you will write down service revenue credit of 500. So now you have really earned that revenue. And then with accounts receivable, here you cannot use cash because you didn't receive the money, but you will say accounts receivable. I will receive it later. So you increase your accounts receivables to asset by 500. That's what the accrued revenue does. So this is the important one. Does this one make sense for everyone? Okay, accrued revenue, you already have the revenue, but no cash here. Then if this is just something extra, if the client would eventually pay you, then you will, of course, increase this 500. Your cash will go up by 500. And then originally here you created the accounts receivable that will be offset. So here it was created, and then here it's offset. So now it's off your balance sheet. So you debit the account receivable to create it, and then you credit it to offset it. Okay, just something extra.
So is an accrual the same as an account receivable?
The accrued revenue is a bit more general. Yeah.
Okay.
But I think the accounts receivable is indeed the most important one of it. I cannot come up with another one, I think.
All right.
Yeah, I actually think that's the most important one. Maybe the only one. Yeah. So an account receivable is, I think, the most important one. Yeah. Okay. Then, do you guys remember this deferral here? Was this a deferred revenue or deferred expense? Company received 1,200 in advance for a 1-year service contract. Was that a deferred revenue or deferred expense? That's a deferred revenue, right? So with a deferred revenue, you already have the cash, but we could not already write down revenue yet. But what I want to show you here, something extra. is 3 months later, then you have performed a quarter of those services. So pay attention to this one. This is also pretty often on the exam. So here we already got paid for a service, right? That we performed. So we got 1,200, and then we set this liability unearned revenue because we got money in advance. That's a deferral, a deferred revenue. But 3 months later, we have earned 3 months out of the 12 months from that 1,200 we received, right? So we already earned 300 euro of that. Do you guys understand that? Do you guys agree with that?
Yes.
Then this liability that we created by crediting it, we can now lower it by debiting it 300. So that on our balance sheet, we now only have 900 of liability left. That's what I want to show here. So again, I created this unearned revenue, it's a liability, but now I had 300 euro of services performed, so I can lower that liability by 300. Okay. Then we go to the next one. A company pays workers 2,000 euro worth of wages. Okay. This is an accrual, and this is an accrued expense. So with an accrued expense, we said you already have the expenses. We hired the workers, they work for us, so we had the expense, but we didn't pay them yet. We will pay them later. That's an accrual, right? Expenses now, cash will be paid later. That's what you have in this story. So I have to write down this wage expense 2,000, and then the wage payable will also be 2,000. It will not be cash yet, but just wage payable, which is a liability of 2,000. Is this also clear for everyone? Yes? Okay. Maybe I can now give some additional information which might be interesting. When do you make those corrections? Those adjusting entries that we're doing here, you will always make them just before you set up the balance sheet and the income statement. So at the end of the fiscal year, there you will make those adjusting entries just before you set up your balance sheet and your income statement. You might want to write it down for your understanding. So at the end of the book keeping period, at the end of the fiscal year, just before you have to set up your balance sheet and your income statement, there you will write down the adjusting entries at the end of the year. Okay. And with those adjusting entries, it might be interesting to already tell you this. With the adjusting entries, you never do anything with cash. So you will see that here. This is an adjusting entry. We don't use cash. You always use one balance sheet statement and one income statement. So this is my income statement account, and this is my balance sheet statement account. That's always the case. One income statement account and one balance sheet statement account. Also with the previous one, I don't do anything with cash. I use one balance sheet statement account and one income statement account. Pretty interesting, right? It's always what you are doing with adjusting entries. The entries you make just at the end of the fiscal year. Okay. Okay, something extra. If you would then eventually pay those wages, then of course your cash goes down by 2,000. And this liability that you created here will now be offset by debiting it. Does it make sense? So to create that liability, you credit it, and then to pay for it, you debit it. That's what you're seeing here, right? Yes. Okay. And why I'm telling this, why do I emphasize those adjusting entries that much? Well, we are at slide 37, but I will go a bit to the front. If you look at the exam, you just have the regular journal entries. So here you have just normal journal entries that we already practiced a bit, but you are not able, you don't have the knowledge to do all of those yet, but that's what I'm going to explain later. But you also have a part on your exam where they say you have adjusting entries. And with all those adjusting entries, you now have learned that you never use cash. So you know with all those questions from 7 to 10, you will not use cash. That's nice to know. And you know that you have to use one balance sheet statement, one balance sheet account and one income statement account. So if you look at the solution here, you never see any cash here on the exam. And you always use one income statement account and one balance sheet statement account. One income statement account, one balance sheet statement account, etc. So that's nice to know, right? If you get this on your exam. Okay. So back to slide 36. Just telling you why I'm explaining this. Okay. So here we were left. So that was the wages. Then the last one. What you're seeing here was the deferred expense, right? So we had some insurance premium. This one we already did. We already paid for the insurance. And then this was not an expense. It was an asset, right? So we do have some cash here with the deferred expense, but we don't have an expense yet. It would just be an asset for the time we didn't use it yet. Okay. Then they might say, after 2 months, the expense is recognized as it's earned. So to correct for this deferred expense, we have to make the following adjusting entry. So what you have to do is you have to say, okay, 2 out of 12 months have passed, and that times 2,400, that is 400. So 2 months later, I already used 2 months of insurance. So I now have to write down 400 of insurance expense. So here I do have to use some insurance expenses, right? And then here I created that asset originally by debiting. So now I have to lower that by 400 euro because now I use some of that prepaid insurance premiums. That's basically what you did here. Do you guys get that? So this is my adjusting entry. And again, I'm not using cash by this adjusting entry. And what I'm doing here is I'm using some income account and I'm using some balance sheet account, right? Always the case with adjusting entries. Okay. So to summarize, we have deferrals and accruals, and then the accruals or deferrals can be based on revenues or expense. So you have 4 different situations. And the 4 situations make a difference between cash flows and revenues and expenses. And it's a special situation on the exam. Okay. So because of all those journal entries that we have to make corrections. So here we had 400 insurance expenses, 400 prepaid insurance premiums. And then here you will see that we make some change. You see that? I highlighted it in red. And then you are doing that for all the journal entries we just made because of the adjusting entries. And what you will see is that those total numbers might have become a different number, And to check if we did everything correct, the sixth step is to make the adjusted trial balance. So you just copy those numbers here, 3,500. And then you adjust this number here. You see that? So with prepaid insurance premiums, prepaid insurance premiums, prepaid insurance premiums. That's what you're seeing here. And then you get 21,700 on both sides. So we are almost there. We only need to do one more step, but it's nice to already summarize the steps. Step 1, analyze, right? You just get the sentences on your exam. Do you guys know what step 2 was? The most important step for the exam?
Journaling.
Journalize. Those are very different. So we will, after this example, we will focus a lot on journalizing, on all the different complications you can encounter. Step 3 was, it starts with a P, posting, very good. Step 4, it starts with T, trial balance, very good. Step 5, what is it? AD.
Adjusting entries.
Yes, very good. And then step 6, adjusted trial balance. So the adjusting entries were because of differences between cash flow and revenues and expenses. And then and you also do those adjusting entries at the end of the fiscal year, just before you set up your balance sheet and income statement. Then you make the adjusted trial balance to see if you didn't make any mistakes here. And then step 7, that's the final step. That's the financial statements. And that's what I'm going to show you right now. And then we're done with this example. So you take the cash, for example, and you put it in this balance sheet. So 4,800. You know that equipment is 7,000. So you take it and you move it. You put it in the balance sheet. You do that for each number. And you will see that some numbers need to be relating to the balance sheet, and other numbers will be relating to the income statement. So for example, the service revenues, if you see that in your adjusted trial balance, where do you see it? Revenues here, service revenues 8,800. Those will go in your income statement here, etc. The only thing that you could not know is this retained earnings. That one is not visible. However, you can assume here that the starting value of retained earnings was 0. So that's an assumption here. We start with a retained earnings of 0. And if you then have a net income of 4,400, the dividend is 0, then you end up with 4,400. Okay. So in general, for in the future, you can remember the following. The ending value of your retained earnings is the starting value, which was 0 in this case, plus the change in retained earnings. So end value retained earnings is starting value plus the change in retained earnings. That's the formula you will have to use in the next question. I will show you. Okay. Is it then clear how you can make this final statement, how you can make the income statement and the balance sheet? Is that clear for everyone? Okay. And on the exam, you probably don't have to do the whole accounting cycle. That would be too much work, but you need to be able to do parts of it. Okay. And here's a midterm question for you. Take your time to read it. You can send me the answer via Zoom. I don't expect you to know it. You probably will get stuck somewhere, but I will give you once in a while an extra hint. So I will eventually give you some hint. Take your time to read it. I'll get some water real quick. Okay, the first hint I will give you is the following. We know the dividends, right? It's 10,000. Will it be on the left side or on the right side? What do you guys think? Yes, dividends are on the left side because they reduce the equity. What about the fees earned? So fees earned is a revenue. They always use a bit different names in the exam sometimes. So the fees earned is a revenue. Should it be on the left side or on the right side? Yes, fees earned should be on the right. So here, I don't know what it is, but it should be on the right side. Then the ICT expense is 26,000, right? Left side or right side? Should expenses be on the left side or on the right side? Yeah, on the left side. If you forgot, you could have looked at energy expense. Expenses are always on the left side because they need to lower equity. Okay. So now you know this. And we want to know what is the retained earnings, right? What is the level of retained earnings? At the ending balance. Now I can erase this. I don't need this information. I know what they want. And I copy the information. So is it okay if I delete this? What do you say here? What's the number you're telling me, huh? Are you saying that this is 135,000 total? Is that what you're saying? No, no, that's not what you're saying, I think. Oh, no, no, that's too fast. I don't know if that's the final answer. Okay, so I want you to do it on your own, but indeed the next step is that this is 189,000. And this is also 189,000. So you know that those numbers plus something should add up to 189,000. So those numbers plus something should add up to 189,000. So maybe you guys can figure out what X is. So just continue working on your own. I'm just giving some hints once in a while. Okay, let's finish it up. So could somebody tell me what this X should be? Under 35,000. Okay. Now I know that the ending value of the retained earnings. Let me write it down. Will equal the starting value of retained earnings plus the change in retained earnings, right? Everybody agrees with that? Okay. What is the starting value of my retained earnings? So at the beginning of 2019, it was 20,000, right? Yeah. Do you guys know the formula for the change in retained earnings? It was the revenue minus the revenue minus the expense, indeed, minus the dividend. Very good. Okay. So that means I can just calculate it, right? Starting value was 20,000. Revenue was 135,000. Expenses are 6,000, 26,000 and 80,000. Need to move it a bit to the left. Oh. And then minus the dividend. The dividend was, what is it? 10,000. So what do you get? We started with 20,000 plus the revenues of 135,000 minus all those expenses and minus this dividend. What do we end up with? Could somebody tell me that? It's the final value. Is it 33,000? Yes. Do you guys get 33,000? Great. All clear? Are there any questions? So here in the next slide, you can see more clean, detailed solution. Okay. So we now have 15 minutes left. So what you will see how the course will be structured from here on. You now know how to get the balance sheet and the income statement right. We now simply need to go all through all the difficult complications you can encounter in the exam, like paying suppliers, being a supplier, transportation costs, returns and allowances. We will go through all those situations, and then we will finish it off with some exam exercises. So I will just make a start on those complications, and I will continue on it next Monday. So the first thing you have to keep in mind is, do I have a service provision company or a merchandising firm? It's not that important, but here it is. With a service provision firm, you're performing a service, like a tutoring company, right? There you're working with service revenue. With a merchandising firm, you're buying goods for a low price and selling it at a higher price. That is a sales revenue what you have there. So here you have service revenue, and here you have sales revenue. A small difference, but it is important. It is a bit important. Also, with merchandising, you of course have inventory and cost of goods sold, and with service provision companies, you don't have that. The manufacturing firm, that will be discussed later. That's when you are making from raw materials some final product. That's discussed in week 4. So then I said the boundaries are fuzzy and dynamic. So what do we mean with that? Well, in real life, you cannot exactly figure out to which category a firm belongs. So if you have a barber shop, for example, I think you would say he's a service provision company, but he will also sell some some gel or whatever. And then if he sells the gel, that's a merchandising activity, right? So therefore it's a bit fuzzy, and it also can change over time. Maybe you start like a merchandising firm, but then eventually you also become a manufacturer as well. So it might change over time. Okay. So this is just some overview. Here you can see it. You use service revenue for service firms. And with merchandising firms, you use sales revenue. You see that? And then you do have some cost of goods sold and you do have some inventory there. That's the biggest difference. Okay. The question is, how do you get this cost of goods sold for a merchandising firm? So to get the cost of goods sold of a merchandising firm, it depends on the inventory system you use. In this course, you will have 6 different situations that you can have in theory. And the idea is that you will have that in week 2. So it's not important for today. But the first distinction is, do you have a perpetual inventory system or a periodic inventory system? With a perpetual inventory system, each time you sell something, you also will record the cost of goods sold. I hope you remember it with the matching principle, right? Sorry, is this also in the summary? I now see that question, Isa, but you already asked it 3 minutes ago. About what were you talking? What were you talking about, Isa? When you asked, is this also in the summary? I truly don't know about what we were talking when you said, so you say, yeah, actually all of these implications and stuff. Could you say which slide it was? Okay, sorry, I just don't know where you were talking about. So I don't know to which slide it's regarding. Okay, so do you guys remember the matching principle? So we said, if you buy something and then you sell something, you don't want to put your expenses in this year. You don't want to put your expense in 2017 if you're selling it in 2018, right? Because of the matching principle. So we need to make sure that the expenses plus the revenues would be allocated to 2018 in this case, right? Okay. So that means that here we have the revenue and here we have the expenses, and they should be matched. That's according to the perpetual inventory system. So each time you sell something, you also write down the cost of goods sold. That's the most important thing. However, with a periodic inventory system, it goes a bit different. There, if you sell something, you only record the revenue. So you would think, okay, that's strange. But then at the end of the period, just before you set up the balance sheet and the income statement, there you will figure out what your cost of goods sold is, and then you record it. That's what you will do with a periodic inventory system. In this course, we will use the perpetual inventory system. So that's what I will show you here. That's as far as I'm concerned, that's what you have to do on the Excel. Okay. Then, given that you made your first choice, so you made your choice to choose for perpetual inventory system or periodic inventory system, then you have 3 extra options. And that is LIFO, FIFO, or the average purchasing price method. I will discuss all of that in week 2, but just so that you have an overview. So there are 6 possibilities to do this with accounting. So your first decision is, do I use a perpetual inventory system or periodic? And secondly, FIFO, LIFO, or average purchasing price method. I will discuss that in week 2, so don't worry about that yet. We will now continue with perpetual inventory system. Okay, so here is it. This is the last thing I will explain. What we will do is we will look at 6 or actually 8 very important transactions. We're going to look at all the possible transactions for a buyer and for a seller. So what if we buy something and what if we sell something? And then you just have the main situation basically be. Okay, so the main situations. But then there will also be some complications. And the first complications that you will have are if you have transportation costs. And another situation that you can have, another complication, is that you will have returns and allowances. So that means that you're the customer and you want to return something you bought, or you're the seller and your customer returns something to you. And you have discounts. Okay. So those are 8 different situations. And we will discuss them and then we're done for today. Okay. Let's start with the first situation, the main situation if we are the buyer. So if you're the buyer, you're going to buy something, it works as follows. Your inventory will go up, so you debit the inventory. Then you have 2 options. So we already saw that the merchandise inventory goes up. You can either pay it on accounts, so then you will have some accounts payable liability, or you pay it directly with cash. Those are the 2 options if you're the buyer. So those are the situations. That's just the main situation. Does that make sense? I think that's not that difficult, right? So that's the first situation. You debit your inventory and you credit cash or accounts payable. Then 7 more to go. The first one is the transportation cost. This slide is not that important, but here it starts. So the idea is that if you always want to register the inventory on your balance sheet at cost price. So you want to register the inventory at your balance sheet at the cost price. So here's the insight. If you are the buyer and you have to pay for the transportation cost, you will just make it part of your inventory. So if you paid 100 euro in transportation cost, you would just increase your inventory by 100 euro because you essentially paid 100 euro extra for it. That's the idea. Okay, so how does it work? You buy 10 kilogram of mint leaves for 12 euro. That's 120 euro in mint leaves, right? But you also have to pay 15 euro for the transportation cost. So that means you in total are essentially paying 135 euro for that inventory. So here's what you will do. You would just increase your inventory by 135 and your accounts payable by 135 as well. So the key insight with transportation cost, if you are the buyer and you pay 15 euro of transportation cost, you just increase the merchandising inventory also with 15 euro. So you bought 120 euro of inventory. And if you pay 15 euro of transportation cost, you just simply include it into that merchandise inventory. Okay? And that's the whole thing here. Is this transportation cost also clear for everybody? You just make it part of your cost price. Okay. Check. Returns and allowances. So if you have some returns and allowances, it just is the opposite of what you initially did. And let me tell you, first of all, why. So a return is just you bring back the inventory to your supplier, right? But what's an allowance? Let me give you an example. So last year, I bought a closet, and when I received the closet, I noticed that there was a scratch at the back of it. And I didn't mind it that much because I would just put a closet against a wall, right? So nobody will notice the scratch. So I didn't want to return the closet, but I called the supplier and I said, yeah, I have this scratch on the back of my product and I don't mind it that much, but I would like to have some reduction in the price. So then the supplier said, all right, fine, Mark. So I will just lower your price by 100 euro. So that's an allowance. So you don't return the product, but the supplier tells you, okay, 100 euro will be deducted from the price you have to pay. That's an allowance in this case. Okay. And the idea is we categorize that as one thing. So returns and allowances are treated in the bookkeeping the same way. So in practice, it's of course a different situation, returning a product or getting an allowance. But for the bookkeeping, it actually doesn't matter that much. That's why it's categorized like one complication. Okay. So here you can see an example. So we bought the mint leaves, but 2 kilogram is brown upon arrival. That's not how it should be. It should be green, of course. So we called the supplier and we said, yeah, I had those brown mint leaves. And then the supplier said, sorry, you know what? You have to pay me 24 euro less to make it up with you. So originally, when we bought the mint leaves, we had to pay 135. That's our liability, right? But now, because of the bad quality of the product, the supplier says, okay, well, you have to pay 24 euro less. Originally 135, but now you can subtract 24 euro from that. So does it make sense that we now do the opposite of what we did earlier? We lower the accounts payable by 24 euro. Does that make sense? Okay. Then with the merchandise inventory, that one here will be also lowered by 24. That is because the cost price is now 24 euro less of that mint leaf. So you basically pay 24 euro less. Does that also make sense to everyone? Yes. And that's the whole thing. So then we basically finished this situation with the returns and allowances. Okay. So, by the way, notice also that it doesn't matter if you return those mint leaves or that you just throw it away in the trash bin, right? That really doesn't matter here. Okay. So I noticed that I'm already at my time. So I think I would just finish it up so that you are at the same pace as my other weekly group. But notice that I'm recording it. So if you have to go, I completely understand that. Then you can just watch back the recording. Then you can watch back the last 10 minutes. But I will try to finish up at least those complications you're seeing here. So then the discounts. With a discount, you deduct something of the invoice price. So let me show you an example. So you buy 62,000 euro of binoculars. And when you do that, you buy it on account. So of course your inventory goes up by 62,000, and then your accounts payable also goes up by 62,000. Makes sense, right? So inventory goes up, accounts payable goes up. But then if you pay within 10 days, your customer will receive 1,240 discount. So let's say that he pays within that 10 days, then he should get the discount, right? So here he buys it, and here he pays with discount. Okay, so what happens here is that this original liability that you created, sorry, you are the buyer. I forgot to tell you the perspective. You are the buyer. So you first bought it and you received the goods, and now you're paying for it. So now you pay. So the liability you created here will now be offset by debiting it. Does that make sense? So here you created the liability because you bought it, and now you will offset it so it will be debited. Okay. You get a discount because you paid within the discount period. So you don't have to pay the full, but you get 1,240 euro here. Okay. This is only 60,760. Am I lacking, by the way, again? Or can you still hear me well?
Yeah, a little bit.
But you can still hear me well? Can you hear me good enough? Or
Yeah.
is it really frustrating?
Now it's okay.
Okay, great. Okay, so you do agree with those two numbers, right? Then the question is, I'm still missing some part because this total liability that we created should now have been disappeared because he paid for it. But I only received 62,760 in cash because I gave him the discount. So the two sides don't balance at this point. So we're missing something. And that's this 1,240, of course, credit. And what name do you give that? Merchandising inventory. So basically you lower the merchandising inventory by 1,240. Why is that? Well, you are the buyer and you receive 1,240 euro less. Sorry, you had to pay 1,240 euro less for that inventory. And we said we want to register that inventory at the cost price. So if you pay 1,240 euro less for that inventory, you have to lower that inventory by 1,240. That's what you're doing here. So we're lowering the inventory, not because we have less products or something, but we simply paid 1,240 less for it, and that's why we have to lower it. Does that make sense? So the complication, the key takeaway is that you have to use this structure, and this number is the discount that you received. Okay, if you are Christian and you just pay outside the discount period, then of course this liability will go away, but you have to pay the full cash. So then you don't have this complication if you don't have the discount. Okay. So that's the discount. So that's from the perspective of the buyer. Now we will move on to the perspective of the seller. And I'm really sorry that I go 15 minutes over time probably, but again, I'm just recording it, so you can always watch it. Okay. The last four situations. You're selling something. You're now the seller. And this is the thing. When you're selling something, you're not only going to record your revenues, but also your expenses. Please write it down. When you sell something, you don't only record your revenues, but also your expenses. Please write it down. When you sell something, you write down your revenues, but also your expenses because of the matching principle, right? And because we're using a perpetual inventory system. So here I sell something for 1,000 euro on account. So then the accounts receivables go up by 1,000 and my revenues goes up by 1,000. However, you also have to record your expenses. And you had expenses worth 750 euro. So your cost of goods sold is 750 euro. This lowers the equity by 750 because it's an expense. And of course, your inventory goes down by 750. Do you guys get that? Yes? Okay. Of course, you could change it. You might have paid with cash. Then the only thing that would have changed is that the account receivable is changed by cash. Okay. That's the main situation, the most important situation, but also the relatively easy situation. You could just memorize this. Okay. Then transportation cost, you don't have to do. I never saw it on the exam. I just include it in the summary if you are really curious about it. But I don't think you need to know it. I never saw it on the exam. Okay, so I'll skip that one. Transportation cost, not part of this course. Then we will discuss the returns and allowances. With the returns and allowances, we're going to use a contra revenue account. So with a contra account, what you're doing is you're going to use some additional accounts to better keep track of the changes in an account. So to give you an example here, we have the account sales, which is 100,000 euro, right? But then I had to lower it by 20,000 because customers returned the product or I had to give an allowance. And also I had to give 4,000 of discounts. So at the end of the day, I only had sales of 76,000. Well, those two here, those are called contra revenue accounts. They offset the sales that you're seeing here. So that's what they're doing, contra revenue account. They offset the sales, the revenues that I originally had to get this net revenue. You should always work with contra accounts so that you eventually get this here. Okay. So let's have a look. So I first of all, I'm the seller again, and I am selling an oven for 1,300 for at a cost of 850. And I receive it in cash. So I get 1,300. That's the sales revenue. And the cost were 850. So also my inventory goes down by 850. This is just the main situation, right? Okay. However, now the customer wants to return it because the oven is defect. And the fair value of the defective oven is estimated at 300. So how does the returning work? So first of all, I have to use this contra revenue account called sales returns and allowances. And you remember from the previous slides what it does, right? So this contra revenue account, it lowers the gross sales to get the net sales, right? So this contra revenue account lowers the gross sales to get the net sales. So by this, I'm basically lowering my sales by 1,300 because the customer wants to return the oven. Then I don't pay the customer directly, but I say, yeah, I will pay you later your 1,300. I will try to pay it you as soon as possible. So that's the accounts payable you're seeing here. That's a liability for me as the seller. And then of course he returns me the oven. So my inventory goes up by 300, which is the fair value of the oven. And then I have to reduce the cost of goods sold a bit by 300 because I thought I had 850 of cost, but now I only have 350 of cost because I received part of the oven back. But notice that on this whole transaction, I have a loss of 550, right? So it's still not beneficial. Okay. That's how a return and allowance works. So this is the journal entry. If they on the exam ask for return and allowance, this is what you will write down. Okay. So this is the return and allowance situation. Then the last one, that's the discount. If you are the seller and you are going to pay, going to give a discount. So when you sell something, let's say you sell something for 40, sorry, you sell something for 62,000 euro with a cost price of 45,000 euro. Then and you pay, you sell it on account. Then accounts receivables go up by 62,000. Sales revenue goes up by 62,000. And because the cost was 45,000, cost of goods sold 45,000, and your inventory goes down by 45,000. This is just the main situation again, right? Here's the complication. If your customer pays within the discount period, he gets 2% discount. And how do you record it? So he pays you with, and he received 2% discount. Well, of course, that account receivable that you had built up, that's gone now. So I have to credit that 62,000 euro. So I don't think you can argue about this number, right? Then with the cash, he only has to pay 60,760, right? Because he receives a 2% discount. So I also don't think you can argue about this number here. But then you will see it doesn't balance. We still need 1,240 here, right? That's what we still need there. And what we use for that is this sales discount. And I hope you remember it, that sales discount was a contra revenue account. And we use it to lower the sales revenue. So that's what the sales discount do. And that's what I want to show you. So if you give a discount and you are the seller, you lower your sales by using the contra revenue account called sales discount. So if you give 1,240 discount, you debit sales discount 1,240. That's what you're seeing here. So those were all the different complications. Okay. And now you're exactly at the same spot as with my previous class. So here's an overview of all the different situations. So the main situation, and then the three complications that you can have if you're the buyer. Here I look from this perspective of the seller. So here again, you see the main situation, and then all the complications. So transportation costs, returns and allowances, discounts. Those are all the 8 situations that you can have. And then here I included some 2 quiz exercises. You can choose if you want to stay here and want to make them with me, but you can also just go. This is the last. I will not discuss any new material. I'm just going to practice 2 more exercises, but that's optional. You can also do it on your own. They're pretty easy. So that's the end of the session. If you would like to join the full course, it's starting next Monday. So for the people that want to stay, I will make 2 more exercises if you want to practice it. You're welcome home. If you are staying, you can send your answer in this chat. Okay, so I already get some correct answers. So everybody that submitted his answer has it correct. So let's go through the question. So you are paying the bill. Should cash go down or up? Maybe a stupid question. Cash should go down, right? I'm paying 2,800. That means I need to credit the cash, right? So I can already eliminate A and D because I know the cash should go down. Okay. And if I pay for something, then my liability should go down as well. So I pay for something, then my liability should go down. So should accounts payable go down or should accounts receivable go down? It's payable. So indeed, the correct answer is B. So what happens is my liability goes down by 2,800 and my cash goes down by 2,800. That's what happens here. Okay. Last exercise. Take your time to read it. Did you read the question? Okay. So the first thing you need to figure out is we are ABC, right? Are we the buyer or are we the seller? Are we the buyer or are we the seller? We are ABC. Okay, we are the buyer. So then you can already know that you have to look at this slide. So we first have this journal entry. I can basically just copy it. Inventory. XXX. And then accounts payable, right? XX. We already know that this is how buying looks like when we buy. Okay. When we return the good, because I think that was the question, right? On the 8th, we return the defective goods. So when we return the good, that accounts payable will be gone. I will receive back some cash. Or I will lower the sorry. Excuse me. This one, of course. The accounts payable will be gone. And the inventory will go down if I return it. So I already know it will look like this. Okay. So that's what we just can copy from the summary. And now we have to set it up. So this is when we buy it at the 5th of September. This is when we return it at the 8th of September. So you can see we can just copy the structure already. You can basically memorize that. Okay. So what do I fill in here for the X? What do I fill in here? When I buy it, how much inventory do I get? The purchase price of the goods was 2,000. The cost for XYZ was 1,200. So what do I fill in?
2000.
So I buy 2,000, yes. And then here as well, 2,000, right? Is this one clear for everyone?
Yes.
Then on the 8th of September, not all the goods are returned, only if part of it, because a part of the goods are defect. And how big was that part of defect goods?
400.
400. So the company, the supplier tells me, Mark, you have to pay 400 euro less. And then my inventory goes down by 400. That's the answer. Is this clear for everyone?
Yes, but how do you know that you need to do the ABC company and that you need to do nothing with the XYZ company of
Yes.
1200?
Yes, very good point. Recorded transactions on the books of ABC company. So that's the key of the sentence. Recorded transactions on the books of the ABC company. That's how I knew it. So then I had to look from the perspective of the buyer.
Yeah, okay.
But in maybe on your exam, they will ask for the XYC company. You never know, right? Okay, so you should be able to do it from both sides. Okay. So that's it. So next Monday, I will continue with more complications like uncollectible counts, and we will practice with more quiz exercises. And then they will prepare you for the quizzes as well. All right. Have a nice weekend, everyone. And sorry for the delay. So,
Yes, thank you. Are the slides going to be
guys.
posted as well?
Yeah, I already put them in the WhatsApp group.
Oh,
So,
all right. Okay, thank you for your time.
You're
Bye,
welcome,
thank
guys.
you.
Just here for questions. So I think everybody's gone. And I think there will be also an online group because I think the weekly course will be full. So I'm pretty sure there will be an online group. I just have to schedule some times then. Bye, everyone.